there is a Swedish holding company called Röko, and since 2018, they've acquired 26 companies, where 16 are B2B businesses and 10 are B2C businesses. And I found two extremely good interviews. One is with the founder of Röko, and the other one is with the CFO with Röko. And I found the best way to learn is to listen to those interviews. So that is the reason for me to do this podcast, to first read the interview out loud and then listening this. So it's going to be quite long, but there's going to be a lot of lessons, because today they do more than 600 million in revenue, and the EBITDA is more than 100 million, and they only do it with having 8 people in their HQ. So there's going to be a lot of lessons from the CFO and from the founder himself. First, we're going to start with the interview Fredrik Karlsson, who's the founder, and then we continue with an interview with their CFO, Johan Bladh. So what are the lessons from your 20 years at Lifco that you applied to Röko? If your business has a high margin, you are doing something well because your customers accept paying a high price. There is a less risk of customer churn when something happens compared to a low margin business. A company with a history of good profit development also has strong numbers, which informs their future. Again, this is the interview done with Fredrik Karlsson, who's the founder and CEO of Röko, and the former CEO at Lifco. So a lot of lessons he learned over this 2-decade experience in Lifco, and he pretty much brought this to build Röko. So which numbers do you look at? We only look at asset-light companies. We check if the cash flow confirms with their historical EBITDA. What else did you take away from Lifco? We have this thing with sector agnostic and not sector agnostic. At Lifco, our dental business was very focused, and they only doubled their profits from 2019 until today. Whereas in system solutions, which could be anything, they 10x'd profits. If you're a sector focused and the sector is not huge, you run into problems if the sector suddenly gets popular because multiples become too high and you cannot acquire. You will be forced to buy bad companies because there are not enough good deals around. When we look at small companies, we try to find market leaders in a niche with moats, but that is sometimes difficult to judge, and you can make errors on the quality aspect. Did you mean it's harder to judge quality when you are smaller companies? The answer is yes. When they are bigger, you can better understand the moat and asset quality. Yes, those are some takeaways. Why did you start Röko so soon? After Lifco's success, you don't have to do this. The answer: I don't have to do this for money, but I can no longer win an Olympic gold. It's hard if you are trying to do something completely new when you don't have experience. I just turned 60, so my brain is also slower. You cannot win Nobel Prize at my age. Buffett would say you're still pretty young. He's 92, so you have 30 years. But if you have 30 years experience of doing something, it's easier. Do you want to build a legacy or care about the numbers like Buffett? What drives you? For me, it's the competition. Lifco continues to climb the Swedish large cap share list, catching up with old established big companies taking one after another. SKF and Electrolux, the old big Swedish corporations, they are taking company after company. They outgrown them. That is nice, but I started on a smaller scale, so I have to restart. You started small, but it is no longer that small. Is that the attraction of the public market where there is a scoreboard and that's the competition there for everyone to see? For me, it is attractive because if you compete with private companies, you have to somehow relate whether you are doing a good or bad job. Competition keeps you on your toes, and I like the competition aspect of public market. It's also good for us to have liquidity because we promised our shareholders we would go to public markets, so they can choose whether they want to stay or sell. How does it feel to run your own acquirer, owning significant equity versus being a CEO of a business owned by someone else? I had a lot of freedom under Carl Bennett at Lifco. Today, we are a team, so it is more complicated as I have to get everyone to agree. I was more a dictator at Lifco. Do you prefer being a team rather than a dictator? It's different. I had a lot of freedom at Lifco, and I had great support from Carl Bennett, so it was more or less like running your own business. Did you want the bigger chunk of equity? Were you missing that at Lifco? I was remunerated well and still haven't sold any of my Lifco shares. That is good for private individual, but I needed to build long-term wealth for my family. Thomas Billing and I are now have control of the companies, which is adventurous. Did the Lifco compensation plan limit your bonus to 70% of the base salary? There was a cap on the bonus, and I always received the maximum bonus. Did you have to buy your 300,000 shares of Lifco personally? I bought my shares at the public offering in 2014 at full market value. I also bought more when I quit Lifco. Was it hard to get a real stake in the business? I was offered a big stake in 2000, but I didn't dare because I had young children and I had recently bought a house. I had loans, so I didn't take the opportunity. Were you more risk averse when compared to today? Yes, now that I have money, it's a completely different story. During the past 4 years, Röko has gone from a blank piece of paper to 100 million euros in EBIT. If you list it today, it would probably get 30x multiple, which equates to a market value of 3 billion euros. Did you think it was possible to create so much value that quickly? I tried to get a good team. Then we would see what could happen. We didn't have a clue at first if we could use that money to acquire these companies. No other serial acquirer has ever scaled to 100 million in 3 years. Doing this for 10 years before Lifco and 20 years at Lifco, it's much easier if you have experience because you know exactly what to do. You bought many businesses quickly though. Lifco bought the same amount of businesses as Röko did last year. I do the same thing whether I'm sitting at Lifco or Röko. There is no difference. It is slightly different because Lifco have 100 businesses which cash flow, whereas you only have 20. Lifco is more diversified, so they can be braver. It is the growth that is important. Half of Lifco's businesses will be new within 4 years because these businesses renew themselves. Why did Lifco not make that many acquisitions between 2006 and 2010? My shareholder was happy to increase profits annually. That was my goal. I was under no stress, nor did I have anything to compare it against. Was Carl happy with simply growing profits? Carl was happy and profits were growing. He gets a dividend. It was a private company, but that changed in 2014 when we went public. You acquired one company in 2014, 7 in 2015, then 11, 13, 10, so it accelerates year on year. Public markets are good as you can benchmark, and I was happy doing 3 acquisitions per year. Why did you choose to be actively sector agnostic at Röko? Between 2014 to 2012, Lifco increased profits 2x. Demolition and tools was 6x, and system solutions, which was the sector agnostic division, grew 10x. We didn't have a magic formula for software businesses like Constellation did when we started. It was better to go sector agnostic and invest in good companies where management want to stay on and run the business. How do you look at the risk-adjusted return when entering areas you know less about, such as outside of dental, for example? Having good financial performance for several years is vital. It's much stronger when you belong to an industry if you are not Constellation Software. They are buying recurring revenue, whereas Pets and Beauty is more cyclical. Pets Beauty is not affected in crisis as they go for the high-end market. Is a craft beer business far more cyclical than Constellation Software? Yes, the craft beer business is slightly cyclical. The great benefit of being sector agnostic is it increases your runway so you can acquire more. But you have to know the sectors and businesses on a wider scale, which arguably increases the risk of making mistakes. Yes, but it also increases the quality because you have a greater choice and are no longer forced to buy bad businesses. Pets Beauty may be consumer, but it's higher quality than a dental business Lifco might buy because you buy the best possible businesses in that space. Yes, this is correct. How well do you know the beauty industry? Well, I've been involved in many industries throughout my life, so I look at the company and the competition. Do you have to study these industries for 10 years to make a decision? Well, I see how the competition developed compared to the company I am looking at. It is not very good if the company lost market share over a 10-year period. Do you focus on the financials of the business and the competition, customers and suppliers to understand the whole business? This is very niche beauty business, so knowing everything about Estée Lauder doesn't help. You have to study the specific business. Constellation have a pure model in vertical market software, whereas Buffett is a different type of serial acquirer and buys anything and everything and looks at the quality of the business like you do. How would you compare Röko style? Buffett applies the same principles to mature public markets and Röko is immature small companies. It should be better for you in private market. It should be better and easier to find this kind of companies he looks for. What is the big risk? The beauty of this business model is that you invest in many companies in different industries, so it doesn't matter if you make a mistake in one company. Lifco and Indutrade are two of the oldest in the business. I discussed this with Alvesson, who is more experienced in business than I am, and he makes mistakes once every 20, but it doesn't matter. I cannot think of company where we had to close or inject cash. The mistake you can make is buying a company for 20% more and it goes down 10%. But it still contributes cash, and you end up with slightly lower return on investment. What were the biggest mistakes you made at Lifco? Well, we bought several small companies where we couldn't increase profits. One service company had very good development in the beginning, but we had problems with the personnel and quality, and it took our 4 years to get them back on track. Sometimes it's not a smooth ride, and you have to work a little bit to get it going again. Were they typically small or bigger acquisitions where you made mistakes? More of them were smaller. Constellation can do this, but buying a small company without recurring revenue, it's much higher risk. If you are not buying recurring revenue, should you buy bigger businesses? Yes, I didn't realize Constellation were buying such small businesses. I wouldn't have touched them. They buy businesses worth less than 1 million. I would never touch them because I thought it was too much work and risk. Then I saw they had 70% recurring revenue, so now I understand why they can do it. Do you look for recurring revenue or is it not the major factor? The best businesses we bought at Lifco were involved in dental software. Constellation found the perfect niche to buy small businesses. Aerospace spare parts is another, but there are very few niches like that. I didn't know how Constellation worked until a year ago, nor did I know we were so bad at Lifco. There is always someone bigger and better. Well, it's annoying that another company performed better than we did. You can ask me why we didn't go into the software business. That was my next question. Hundreds of companies are trying to copy Constellation. We were too late. Are you open to buying software business? Well, Constellation do many direct deals, but ours are mainly through brokers who are not interested because we don't see many software companies. And when we do, they're extremely expensive. Because private equity comes in and pays 5x revenue. Well, Constellation have the database and now how they can increase profits so they can buy them. Normally, we can't because they're too expensive. Do brokers not bring you software companies? No, because we don't pay enough, so we are not in the game. How many brokers do you use? We have maybe 1,000 brokers because there are so many in Europe. We have close relationships with some of them, and others we have only met once. They could be one person acting as a broker in a certain region. Yes, although we don't usually buy companies as small as Constellation does. We do buy small companies, so it's not Goldman Sachs or Morgan Stanley. Going back to being sector agnostic, when you look at serial acquirers such as Lagercrantz, the old Bergman and Beaving, Adtech, and even Lifco, focusing on dental, demolition, or tools, what advantages, if any, did they get? Well, we always looked at companies individually. If you want to make a company public, you have to put them into baskets. You have to tell a story so they are not really segments. We always look company by company. Were there any synergies in having 20 dental businesses? There were synergies to some extent as they shared the same warehouses. When you were going to increase prices, did you know what could happen? Well, we saw immediately if a company had too much cost or were running the wrong pricing strategy. Constellation don't do synergies. This is more about knowledge. How does Röko do that without the knowledge from 10 beauty companies? There is no value having all the knowledge if there are not enough companies to apply it to. If you don't know how 20 beauty businesses perform, you have to buy better quality businesses because you don't know how to run them as well as you would for dental. We look at some general things and always have a feel for that. Before starting Röko, Thomas and I did a private investment in yacht supplying, which was a tremendous success, and we know nothing about yacht supplies before acquiring them. Are you looking at the cash flow? We look at whether they need all their personnel and discuss it with them. We ask the companies relevant questions such as in which segments they can increase prices, and they usually improve their margins. The return on sales in the Swedish dental industry went from 5% to 20% during my time. That wasn't because we knew the industry. It was more political, such as high or low taxes. Are there any risk for Röko? One big risk is the recession. Why is that a risk? In 2008, our profits dropped 30% at Lifco. That is the only major risk in diversified companies such as Röko, Lifco, or Indutrade. Another risk is if management make a bad decision, are slow, or destroy the culture. A new manager who doesn't understand that it's a centralized culture can ruin the company. Why do you buy 60% or 70% of the company instead of 100%? Well, management is incentivized to do a good job when we allow them to stay, and they prefer us as a buyer as opposed to those who don't offer that. A business that increases profits every year with a good margin is good for us. That is true especially when buying across different sectors. When you have 30 dental companies and one goes wrong, you can take this guy and put them there. Whether if you have 20 different sectors, succession planning is harder. Well, it is vital to get a good manager because the industry knowledge is within the company. Moving a good manager from another dental company causes problems. How do you find them? Recruiting internally is less risky because you know the people. Buffett buys 100%, but the founders always stay. But maybe it's because he's Buffett. My first acquisition was a Norwegian dental company where the owner had 15%. But he stayed on as a manager because he knew his industry and he loved his work and customers. It's about finding those fanatical people who love their job, right? Yes, they stay on if they love their job. How do you tell if a founder loves their business? It is more a feeling, and people are honest when they sell. They normally tell us if they work too hard and feel like a change in their life. A few people tell a story, but not too many. You have to get that feeling of someone who knows their business. Yes, because it means you delivered constant growth for several years and are better than your competitors. The numbers prove you are doing something right. Is there a risk at the end of 10-year put-call option that the founder leaves? The risk differs per industry. In the beauty business, she wants to stay on, and we have a discussion about prolonging options about 2/3 of the time. there is always a discussion at the end of the period about whether they want to stay or not. When that person wants to leave, you need a succession in place, right? In that case, when the person leaves, they were very clear from the start. We recruited a new bad manager, then I recruited another one who will hopefully be good. Is that the challenge to find good successors when the original founder leaves? Yes, but big companies are less challenging because they can afford to pay. It's trickier for smaller businesses who can't pay a proper salary. Why don't more companies offer founders the 10-year put call option? We only started doing that recently at Lifco. Why did you start doing that 10-year put call? For those circumstances where they wanted to stay on. Normally, they do a 2 or 3 year earnout and a standard bonus. Intertrade is the earnout company, but the problem with earnouts is that managers are solely focused on them instead of the longer term. We sometimes use earnouts, but it always turns out more expensive than buying cash from the beginning. They always hit it. Well, they know the businesses will develop over the next 1 or 2 years. What metrics do you look at during your due diligence process? We look at financials, specifically consecutive profit growth. We increased our minimum margin to 15% because our average is between 18 and 19%. I thought your 10% margin target was slightly low. Well, 95% of our opportunities cannot meet this financial criteria. Why do you have no target metric for return on invested capital? The industry average is 8 times EBITDA, and that hasn't changed in 20 years. Why is that? Well, I don't know. It has no connection whatsoever to the stock market. Why is that an arbitrage that will always exist? It has existed for the last 20 years. We bought a company who sells artificial flowers. They had 37 offers, but we won it as the normal rates. A small company with a founder is riskier, so it's worth less than a public one. All this proves is that a bunch of them are worth more. Your return on investment is 12.5% before you have done anything. Between 2010 and 2019, Lifco had 9 good years where almost all their companies increased profits, making the return on invested capital better. There is also amortization of intangible over time, and the base gets smaller. The older a company is, the higher the return on invested capital. We are very young, so ours is only 12.5%. Our average holding period of our 26 companies is 1.5 years. So we are basically still at what we paid. If a business comes to you, do you look at the invested capital and return they are currently earning at the OpCo level? The return on their capital is normally more than 100%. Yes, because they have no capital. Well, they have some receivables, some stocks, and very few fixed assets and high profit margins. Some companies like Charges Scientific say that they look at the OpCo level. As you said, over a long period of time for the HoldCo, Röko, the return on invested capital will converge with the returns on the underlying assets. It will increase over time, as you have seen at Lifco. Lifco never bought companies with under 50% return on capital employed. Most were closer to 100% or even 150%. And aerospace spare parts business could be low initially due to their stock, but as they increase prices, that will be justified. We never buy any paper manufacturing or asset-heavy companies because it simply doesn't work. How did you come up with metrics such as continuous profit growth, EBITDA margin, manager in place, capex under 5%, size and customer concentration? Did you read Buffett, Fisher, and others? At least 70% is Buffett and or Fisher. I simply read the book about this. Philip Fisher? I think he talks about continuous profit growth with only 2 profit drops in 10 years. Some were inspired by them and others is seeing what worked personally. Do you follow Buffett or Berkshire Hathaway? No, not what he's doing today, but I do read papers about how he thinks. I do read his annual letter after someone summarizes it for me. Do you follow anyone like that in Sweden or any of the old families? My greatest hero was Jan Wallander from Handelsbanken, which is used to be Europe's best bank for 40 years. He was the first to push for decentralization by letting the management of each bank decide up onto certain level on individual loans. He pushed that responsibility down in traditional banking. He did that in the 60s, which stopped budgets which take time and add no value. How decentralized is Röko? It is the same. Do you tell them to have specific HR or financial ERP systems? The only thing they need to do is complete our monthly Excel spreadsheet. They have to report every month, connect their account to ours, and deposit excess cash. We decide what dividend to pay out for each company. Do you send them an Excel file and they report to you monthly? Profit and loss and balance sheet. Do you have an auditor who does that annually? We run quarterly reports like a public company that are on our homepage. We will go public when things calm down after the recession, if that happens. You increased your EBITDA margin target from 10% to 15%. Why not higher? Say around 20% like Constellation, for example, which earns 25%. Well, they buy lower margin companies, then increase their profits to 25%. Why can't you have 20%? My personal experience with manufacturing businesses is that in a 2009 situation is that you need to begin with 15% operating profit, otherwise you will make a loss. Why not have 20% as a hurdle rather than 15%? If you tell brokers you only buy companies with 25% margin, we won't see anything. When you are public, people don't like it when you decrease your margins. Why did your margin decline 1% last year? We had problems with our businesses that increase prices not quickly enough. It's also a culture thing. Entrepreneurs love to grow their business but are not as interested in high margins as we are. Because your cash flow decreases with lower margins. We still have some work to do to get them understand that. You must operationally change their mind as to how they focus on margins, right? Yes, you have to be very clear that it's extremely important to keep the margin. Bergman and Beving say you can grow with a profit over working capital above 45%. Otherwise, you have to focus on margins. We can say that because these companies are above that 45% threshold. We tell managers that they shouldn't lose their margins, but pricing is always an art. How do you think about organic growth? It is good enough for us if organic growth is 1%. Well, is that because their returns are so high? Well, even Constellation Software doesn't have high organic growth. It is better to have secure cash flow than high growth. That way you can buy new businesses. If you have new businesses to buy, yes, there are always available businesses when you're sector agnostic. How do you balance that? Because some companies focus on higher organic growth and others focus on redeploying free cash flow quicker, buying more businesses. How do you weigh up buying more businesses but also making sure you have quality assets and they are at least maintaining their growth or their absolute dollar size in EBIT? If they start to decline 5% or 10% a year, then that's a problem. Well, it's very rare to these kind of businesses. If you speak to Alvesson at Indutrade, most business grow on average. They can decline 5% to 10% in a single year, but not year after year. This is really bad. What if your business doesn't grow and the organic growth remains zero? That is not a problem if you invest their cash flow into other companies. Is your model similar to Berkshire Hathaway, but for smaller businesses? Yes, correct. You buy whatever you want and choose good managers like Buffett does. He doesn't get involved in the companies. He's simply a capital allocator. He invests the cash flow by buying public market shares and private companies. Well, we only buy private companies, but he has to invest so much money that he's forced to buy public companies. We prefer private companies because they are much cheaper. Buffett does what I call investment nirvana. He buys a business with good management, then does nothing. Isn't that the dream? This is the dream, but we have to change management who don't perform. Buffett does get involved in Geico and insurance stuff, and I assume you will have to get involved in health management at some point, potentially, if you have to. The sector agnostic angle should work if you are good at capital allocation because you will always have something to buy. But what will Mark Leonard buy once everyone starts buying software companies? The other problem they face is that they have to allocate so much capital. They are currently doing 1.5 billion a year and cannot buy 2,000, 1 million companies. They have to buy bigger companies. Is that true for Röko as well? We have plenty of room to buy more companies. How do you think about scaling M&A? Scaling M&A is important for Constellation, but we only need to buy 6 to 12 companies per year over the next 10 years, so we don't have to scale our M&A. You can do those yourself every year. We have 3 investment managers who regularly meet with brokers. But do you make the final decision? Yes. We have an investment committee who make the final decision. Today, you do more than 100 million in EBIT. If you assume real organic growth and want to grow 10%, you have to acquire 10 million EBIT. 10 times means 100 million. If you want to grow 20%, you have to allocate 200 million. The numbers quickly get quite big for you. We are the same size Lifco was in 2014. They had 100 million euros EBITDA then and 450 million in 2012. Could Röko beat Lifco over the next 9 years? Well, we have the same investment organization as Lifco today. We can run with our current organization and increase profits 4 times before we have to think about it. Is there any limit to how many you can acquire? Do you have the cash flow to make 5 acquisitions this year, or are you limited by debt? We still have 50 million from our shareholders to invest and can collect a further 100 million if we want to. The current acquisition we are doing is from cash flow. How do you think about optimizing leverage at Lifco? Banks offer decent interest rates if you stay below 3 or 4 times EBITDA in debt. Do you use that to finance acquisitions, or is it that on the balance sheet? Well, when we buy a company, it's usually 3 times EBITDA bank debt, the rest cash. The return on equity invested should be higher than 12.5% on capital. Constellation delegated M&A down to our organization really well, but they can do that because they are acquiring recurring revenue. Buffett hasn't done that because he does it himself. Could you potentially train others like Johan, or will it always be you? Well, I don't have any problem making a decision a day on an acquisition. If I get the right material, I still speak with the management of companies we acquire. I will always go through the financials with an investment manager. Is there a limit? Well, I can do 10 a day, so the limit would be 3,650 acquisitions. I just want to understand what I'm buying. Constellation is different because they buy similar companies, so Mark Leonard doesn't need to look at each individual investment. He doesn't look at the majority of them. Well, I will continue to look at all of them. If you buy tiny add-ons and do not do proper due diligence, you will make a mistake. You have to be as tough with the tiny things as you are with the big things. Do you look at all bolt-ons? Yes, I do. Do you enjoy doing that? Yes, I do. I will be like Warren Buffett, who never stops. It's in your blood. Yes, I will do that until I die. Would you do Röko until you die? Yes, I will do it until I die, if I continue to perform. And if you don't, you will step down. Yes, correct. You would be 92 like Buffett and still running Röko? Well, my retirement position will be a member of investment committee. What age are you looking to retire? I don't want to retire. I want to do business. It's like a Buffett. Otherwise, I will be bored. So there is no need to retire. Well, has Buffett made good decisions over the last 3 or 4 years? Yes, of course. He has outperformed most big managers. He bought Apple and oil companies over the last few years, so he's actually getting better. Well, this is a good news. Then I will continue working. That means you have 32 years left. That's perfect. This was the overview from Fredrik Karlsson, the CEO of Röko. Now, the next one is the interview I found, which is done with their CFO, Johan Bladh. And this gives a better overview of their M&A strategy, their transaction structure, and their returns. So, as I said, it's going to be a bit longer episode, but I would like to cover it all. So whenever you have time to listen the story about Röko, you can just come back here, put on your headphones and just have a longer walk, and you have a great overview of how one of the best serial acquirers in Nordics are actually buy businesses, grow the businesses, and how they're able to produce extremely great returns for their shareholders and for their investors. So this is the interview with Johan Bladh. He's the CFO of Röko and shares everything what they do inside the Röko. So Johan, you're working very closely with the CEO and founder Fredrik Karlsson. Do they both review every deal deck or presentation when it comes in? I am the first filter. I filter things before they reach Fredrik and Thomas. Initially, we looked at everything, and as we progressed as a firm, we are becoming more and more stringent about our criteria. It is very helpful that we also have a bit of better deal flow today. I would say that I only send things to them when I think it's likely that we would want to have a physical meeting with that company. They review information, memoranda, and financial information ahead of those meetings with management teams. In total, I look at something around 300 to 400 opportunities per year. Maybe 100 of those get through to Fredrik and Thomas for further review. I would say that we meet maybe 30 or 40 companies per year in a Teams or physical meeting. What originally attracted you to work with Fredrik and Thomas? I was very intrigued by the model. Obviously, since Lifco's IPO in 2014, that was a company that I was able to track a little bit. So that was a big thing. The fact that Fredrik has proven the attractiveness with serial acquisition and decentralized governance, as I got to know both of them, it was clear that both Fredrik and Thomas were actually very experienced in this. They also have a private business on the side called Hertmans, which is a boat equipment retailer. It is a roll-up serial acquirer within boat equipment retailing in the Nordics. Selling actual boats? No, it's only equipment. For example, life jackets and ropes, both physical and online retail. They were doing that together before launching Röko, trying to work together, which was very helpful. It was clear to me that there was an attraction in business model and an attraction in the way to acquire and govern companies in a fully decentralized manner, which, to be honest, is a little bit different from what I did when I was in private equity. I think it was intriguing to me then, and I still think it's a very attractive model for some companies to join into. How was the governance different relative to private equity? The biggest difference is that we really strive for decentralization and simplicity in everything that we do. Obviously, this is something where it is difficult to always excel, especially when it comes to things such as reporting, for instance. But we always try to focus on key and core things and do things as simply and as fast as possible to ensure that the small and medium-sized companies that we have acquired and invested in remain or retain their competitive advantage, which is normally nimbleness and swiftness in operations and decision-making. Private equity is an active ownership type of governance as well. We can be even faster because of our lower requirements for internal governance at Röko. There are not a lot of committees that we need to go to for decision-making. Do they just send you monthly numbers, simple balance sheet, and income statement? Exactly. We get the monthly report, full income statement, balance sheet. Obviously, from that, we can back out the cash flow, depending on who is technically responsible for that company and also for what the company wants. We have more or less frequent discussions either during the month or around the monthly reporting. Sometimes there are also companies in our group who don't feel that they are in need of frequent and scheduled interactions with the owner, and we say basically let them run. Then it is fully decentralized, I would say. What about HR? Do you make them use one Salesforce or HR system? No, we don't engage in any of those things. The only thing that we ensure that they do is a similar way is that we require all of them to use an auditor that is approved by us and technically by our group auditor. We require them to do monthly reporting according to a template that we have. We acquire the companies to be enrolled into our cash pooling system so that we can handle liquidity in a more efficient way. The cash they earn funnels to your bank. Yes, it's almost as if we are a little bit like an internal bank. Every once in a while, there is a company that requires a bit of revolver for net working capital purposes. Maybe they need to place a large order for inventory, for instance. Most of the time, all of the companies are in a different bucket, so they have excess cash that they need to deploy somewhere instead of having it sitting in their local bank account with no interest. We facilitate the smooth and efficient transaction between those companies, so the one that is in need of liquidity can access it, and the one who is over liquid can get something for it. Let's say I'm one of your portfolio companies. Obviously, I generate cash, and that cash is somewhat funneled into your cash pool, but I need some excess capital, maybe for inventory, or I want to build another site. How do you explore the return on that capital and allow the OpCo to spend the capital? It depends a little bit on the scale. I would say if it is a significant capex investment, then we need to approve all of those centrally. We look at them to ensure that the capital that is then deployed into those capex initiatives provides a good payoff or a good return. It is not so that we have a clear hurdle that everything needs to pass. I think here it is important to remember that we own companies that are in very different industries, very different sectors, and also in different markets. If we were to have one hurdle rate for all internal capex, then I think potentially we would make it too difficult for certain companies to invest in their business. We look at it from a central level, and we need to approve those plans. But otherwise, I would say when it comes to managing cash in the companies and net working capital investments, in all our cases, the local management owns shares in their companies. The way for them to be able to take out dividends is to ensure that the local company generates profit, but also generates free cash flow. Otherwise, there is nothing to pay dividends with. We think that the alignment of incentives and interest between us and the local management ensures that we want not always exactly the same thing, but similar things. I want to walk through a typical transaction in a moment, but can you just describe how you compare Röko serial acquire model is different versus Lifco or Lagerkrantz? I should start by saying I only have an explicit knowledge of our model. I haven't worked with any of the others. I think we're different in maybe a few ways. As I can see it reactively, we are a very small and nimble team. Currently, we are also obviously a private company, which is different to those ones that you are comparing us to. That gives us some benefits in certain ways and some drawbacks in others. But we are a very small team. Everyone who is a decision maker is always involved from day one. For instance, when we meet a company, this means that we can be quite fast and efficient in our transaction process, but we can also be quite fast and efficient when it comes to other decision-making processes internally. Just to provide you with a little bit of context, in our head office here in Stockholm, we sit in a co-working space. We have a room that is 20 square meters or something like that, and that's where everyone sits. We are 5 people here at the head office, and then we have our satellite offices. Anders Norby is often in Oslo, covering Oslo and the UK. Then we have Fabian Spacer working from Switzerland, covering DACH and continental Europe from the sourcing perspective. Small and nimble. We are basically about short decision-making routes. We are fully sector agnostic, which is a little bit different from others. Maybe then to paraphrase a little bit, given the use of agnostic, we are almost religious, you could say, in our view on financial characteristics and criteria of businesses. We assess and subsequently hopefully acquire provided that they meet those criteria. The thing about sector agnostic means that we can always have a relatively wide net and see quite a lot of opportunities. And then we can make a decision where we can invest our resources, both our time and our money, when it comes to trying to acquire what we think are attractive companies. Just on that point, though, because I think it's interesting, I've seen the presentation and what you say around clearly casting the net wider gives you more runway and more opportunities to allocate the capital, but you also have to know what you're buying. You own a beauty retailer, you own various different businesses. How do you think about understanding these and markets or businesses? Just on that point, though, because I think it's interesting, I've seen the presentation and what you say around clearly casting the net wider gives you more runway and more opportunity to allocate the capital, but you also have to know what you're buying. You own a beauty retailer, you own various different businesses. How do you think about understanding these end markets or businesses? Well, it's not the balance that we walk or try to manage every day, because we have taken the decision to be sector agnostic, but the balance between those models is exactly that. I think the way we look at it, we are very firm on our financial criteria. We only buy companies that have grown profits continuously, historically, and we look at that from a reported historical financial perspective, at least 5 years, but preferably longer. Normally, we look at the company's EBIT over the last 5 years. Has it been growing? If it has been growing, has it been growing with a relatively steady pace? So no hockey stick, not a lot of volatility. You can have a very nice scatter over a 5-year period of time, but it could embed volatility over year. We don't like that. We like things that have almost a straight line when it comes to profit growth historically. Then we like companies that have high operating profit margins, which we define as being above 10%. But if you read our report, you will see that on group level, we are closer to 20%. We are not really 20%, but 18% EBITDA margin. We think it's important that you can prove deliverability of those two for a long or relatively long period of time historically. 5 years is long in your mind? No, but it is at least an indication. I think 10 years is okay, but 5 years is at least an indication that we can work with. If you look at it over a longer period of time, then my sense is that normally something has happened every once in a while. A company may have made an investment in a product line that they didn't work out 7 years ago, and you can see that in numbers, but that's normally something you can live with. Or you can have a period when COVID happens, for instance, which could have a very positive effect on some companies and very negative on others. But at least the 5-year gives you an indication. We see that you have been able to grow your profits at a good and steady pace. And if you have had a high operating profit margin over time as well, not just 1 year, it's at least an indication that this company is doing something right. They probably have an offering to customers which adds value, which customers are willing to pay for. Depending on certain other characteristics, you can get the sense for whether they are capable of pushing on price increases to their customers when they see raw material prices increase, for instance. If we see those things, then we say, okay, the next step is for us to sit down with the management team. If you have seen good development over the last 5 years, we would like it if the management team who is there today is the same management team that delivered that, so that we can get the better understanding of what's really behind the numbers. Then to do that assessment, at least Fredrik, Thomas, and myself, but normally also Anders, we attend those management presentations. We meet all the management teams in the companies that we invest in. Why do you only acquire roughly 70%? It's not even by design, to be honest. We acquire majority stakes. We could acquire 100% of a company. But what we have seen up until today is we have focused a lot of buying founder, family owner managed businesses. And quite often, the seller who are then also the entrepreneurs want to retain a stake as part of the transaction. In certain instances, it's because the only reason for them to do that transaction is that they want to take some money off the table, not selling the company. And then it's natural that they obviously retain a stake. In certain instances, they're starting to think about succession planning. Then they want to make sure that they still have an engagement in the business. It has just happened that we have been fortunate to be able to buy 26 companies since we started, and all those 26 have those kind of situations. We normally have a discussion with the team in terms of how much they want to retain, how much we would want to buy. I would say that we have crept up a little bit over time. If you were looking at this from the start, we normally bought between 60% and 70% in the first 1 or 2 years, whereas now it's more common that we buy between 70 and 80%. Why is that? Well, I think part of it is because we have acquired slightly larger companies where we think that there is a bit of more structural capital in the company. Part of it is also that we are not so sure that there is a big difference in the engagement if you own 35% as of management, or if you own 25% or maybe 15%. It depends a lot on the individual, and for us, it then actually makes life a little bit easier if we own a little bit more from day one. Other serial acquirers, such as Constellation Software and some of the other businesses that acquire 100% of the company, they have that problem of succession and the problem of the founder checking out, cashing out, and retiring. Have you seen succession planning when you buy 70% or 80%, given the founder has a stake relative to if you acquire the whole business? Yes, we have that discussion with the founder immediately as part of the due diligence and transaction process to try to figure out what his or her time plan is that they have in mind, and it varies a lot between the different companies. We have companies in our group where the founders and entrepreneurs are just over 30, and we have companies in our group where the founder and entrepreneur was above 70 at the point of transaction. Obviously, the discussion on succession is very different in those situations, but what we believe is simplicity is really key for us. Speed is really key. Transparency is really key. We try to leapfrog that situation by discussing it upfront with the management team or with an entrepreneur. Sometimes they say I am envisaging myself as leaving the CEO role in a couple of years or maybe in 1 year. Sometimes they just say I don't know what I would do if I wasn't the CEO, so I would just like to continue. Depending on that discussion, we make a plan. We have done full, what I would call successions in 3 companies since we acquired them, meaning that there was an entrepreneur who was the CEO when we acquired, and there is now a new CEO in place. And that has happened in 3 occasions. How do you typically source the 300, 400 deals that you mentioned per year? We focus a lot on sourcing through M&A advisors or corporate brokers around Europe. We build and nurture relationships with brokers in all markets where we are, and could think of ourselves as being active, which is basically around Europe and in all countries. We obviously look for more bilateral situations as well, but it has not been a clear focus for us as of today, because we think that the absolute lion's share of volume of opportunities come through brokers, and hence we have invested more in developing those relationships. Maybe as we proceed going forward, we become a little bit more well-known. Potentially you could see a few more bilaterals for us, but we think that the majority of deals will always come through the broker network for us. So that's where we spend a lot of time. In practice, what we do is travel around quite a bit, and we have a lot of Teams meetings, and we try to behave as we say that we will behave when we do transaction. In that way, when we buy something, we get a good reference, both from the entrepreneur that we partnered with, but also from the advisors who are engaged in the transaction. What percentage of deals are typically auction-based versus exclusive? I would say that 0% are full auctions. If I would compare them to what it was when I worked in private equity, where you have multiple bidders working side by side throughout the entire process, but a very high percentage are auctions in the start, and they are then auctions where the seller invites several potential buyers or bidders who look at the IM, for instance, maybe have a meeting with the management team. and the broker thereafter submits an indication of valuation or an indication offer. Most commonly for us is that after that there is a phase where we are in a bilateral situation, so we know that the seller is only speaking to us. That's normally what it's like. In certain occasions, we have had bilateral discussions from day one, but they have more often than not included a broker even then. But it has been broker-led exclusivity, if you will. How do you think you can get an edge if you run through brokers or effectively mini auctions? I think we get an edge because we work a lot of with deal flow, getting it and then managing it so that we can always look at a lot of opportunities at the same time and decide to go for the ones that we think are the most attractive. That's one where I think our efficiency and stringent criteria can be relatively high. And we can make sure that we invest where we think that the attractions are currently the highest. Second, I think that even if it's an auction, my experience at least is that it's very rare in your size bracket that you just win on price. You win on price or valuation, certainly to some extent. You need to be in the ballpark. But the very important factor is personal fit and seller and buyer being able to meet each other on things that are not just valuation driven. I think our edge can be that we have an offering that is a little bit different from others, and being a little bit different, a lot of comes down to personality, to be honest. Personality and maybe governance structure. How is that different? Take Lifco, for example. Fredrik obviously built Lifco. How is it different to if Lifco or Lagercrantz or any of those companies that have somewhat of a similar governance structure, somewhat of a similar philosophy? How would it be different if you are trying to buy a business that others are bidding on? It's a very good question, but one is that the market for small and medium-sized companies across Europe is not so transparent. We are always up against companies that are objectively a little bit different, not that different from us. If we look at what we understand is our competition in a transaction, it's normally us and maybe 2 or 3 local private equity firms, and then potentially a more strategic or industrial acquirer. And then we differ a little bit on our model, the normal type of transaction. Every once in a while, of course, we are up against other Sweden-based serial acquirers with smaller head offices and decentralized governance. As I said, I think in these situations, it comes down to personality, because even if you would think that we are a little bit similar to Lifco or Lagercrantz, we are not the same individuals. It doesn't mean that we would win in all those situations, of course, but every once in a while, we do. What percentage of acquisitions do you typically feel like you're coming up against another serial acquirer? Well, it depends a little bit on which market, I would say. In Sweden, maybe not at all of them, but at least most of them. It's very high. It's also a relatively high percentage in Denmark, Norway, and Finland. But if we go to UK, for instance, I would say that in most of our transactions, we are probably still the only serial acquirer, at least the only serial acquirer from the Nordics. That's also one aspect where we are from the culture that they feel like we bring and those kind of things. But of course, Lifco does acquisitions in the UK, and there are others that do that as well. We certainly have competition, but for us, it's not so bad to have a bit of competition, because then we also know that the sellers have decided to sell to us. They have made a considered decision where they have been able to assess and evaluate different buyers. Let's walk through an acquisition example. Let's say I have a company doing 10 million euros in revenue, for example. You have an M&A advisor, puts the deck across your desk, you like it, you book a visit, you and the team go and visit the management team. The numbers obviously check out in terms of EBITDA growth and high margins. What are you looking for when you meet that management team? What are you really analyzing there? I think it's part of the situation. As we have spoken out, our model has really been to buy in partnership with management and entrepreneurs. I think we would really want to understand who is the management team and who of the entrepreneurs, if there are several, is a seller in this transaction, and who is important to the business and has been important. Depending a little bit on the understanding of that, we try to make an assessment of if we think that the management team that remains are the high individuals to take this forward with us. That's an assessment that is based on the discussion that we have. It's not a form that we fill out or anything, but it comes down very much to our sense and our feel for those individuals. Apart from that, what we tend to do is in those meetings and in those interactions is obviously to understand all of the things that you don't normally get the full picture of when you read an information memorandum. Those come down to a business logic, where it is positioned in its respective markets, any relevant understanding that we have customer dynamics, supplier dynamics, those kind of things. How do you think about organic growth? Well, we buy companies very much based on their performance until today and on their current state. Obviously, we like them to grow a bit from there, but we don't have a clear view that you should grow top line with X% and EBITDA with Y% or things like that. Let's say I have a 10 million revenue business. How do you model out the returns? Well, normally we look at our baseline as a return on capital employed on the date of the acquisition or in relatively short time after the acquisition of 12.5%. That is our baseline hurdle. That's year one EBITDA over capital you employed. Exactly. And then in certain instances, we can live with that being a little bit lower for some reason. And in certain instances, we like it to be a little bit higher, depending on what we feel are the inherent risks of that business and how well we think it will grow. It will grow going forward, depending on the historical data. It's not that we have, as I understand, that some other serial acquirers have a very clear 3-year plan or a 3-year model, and after that period of time, it should deliver a certain IRR or a certain return on invested capital. It's not really like that. We have a baseline which is this 12.5%, and then no matter which company it is in our group, we look at them based on a set of financial KPIs and financial criteria. We want them to grow profits year over year. We want them to increase margins year over year, and we want them to increase free cash flow year over year. No matter where they are, we want them to improve a little bit year over year. It doesn't matter if it's a company that has technically already grown a lot since we bought it, so that they are now well above that return on capital employed hurdle. We will assess and evaluate that business based on its performance the prior year. Again, take an example of 10 million. Let's say it has 15% EBITDA margins post-acquisition. Well, then unfortunately, it is a little bit too small for us, to be honest, because we buy 2 million and above. But I'm going to live with your example. We can do 100 million and make it 15 to make the math easier. How do you think about using equity to structure the transaction? Well, we use a bit of bank debt, but we are quite conservative. On a group level, we have an interest-bearing net debt of approximately 1.4 times EBITDA. We would do something around that, maybe a little bit higher on day one, but not more than 2x, I would say. I think we can talk about multiples in a second, but let's just make it easier. I think it's 9x to 10x you have been paying for stuff recently, but let's say it's just 10 times to make it easier. I think I will make a few clarifications to start. On average, multiple has actually been below 8 since we started on an EBITDA level, and in 2012, it was 8.0. Are you including everything in that? EBITDA and the put option? Exactly. Everything is included, except that we take out acquired cash or cash in the acquired companies, but that should then mirror the enterprise value that we pay. In our reporting, we report acquired EBIT, which is after amortization of goodwill. So technically, it's not the right metric, but we are working with improving our reporting for comparability. Just to give you the actual numbers, we paid 8 times on average in 2012. But if we use the same analogy, then let's say we have bought the business with 100 million in revenue, 15 million EBIT. We pay 8 times. Then we pay 120 million for it. And if you assume that EBITDA and EBITDA is roughly the same at the point of acquisition, which is normally at least quite close to reality for us, we buy relatively asset-light businesses. Then we would make it call 30 million, so 25% of the 100 million euro mark as bank debt, or up to 30, or maybe a little bit below. And then we would own, call it 75% of the business. We would have a minority stake of, if my math is correct, and it depends a little bit of structure of that 22.5 million. So that would also be a minority or a put call of debt. This is if we acquire 100%. Then we let management reinvest in a new structure. We do both alternatives, to be honest. If you acquire 100%, they invest in this new co and they basically buy shares, right? Yes, exactly. How does the put call option work typically if you only acquire 70%? The put call option works in this following way. At day one after the acquisition, it is valued equal to what the management team invested for that put call or retained as a share in the transaction. Going forward, the put call for each respective company, we have a model that we apply a multiple to the average earnings that that company has had, normally the 3-year average for each company, and we apply a multiple to that and then multiply that with whatever minority share that is retained by the entrepreneur or management team. To put things simply, if the companies we have invested in perform better and grow their profits, the put call option will increase in value, or our liability will increase going forward. If they perform worse, it will go down. So far, we revalue the put call once per year in our financial year end. In 2021, the put call option increased to the performance of the underlying companies, meaning that the underlying companies perform better financially. And in 2012, it was the same. The put call liability increased in 2022 as well. What is the life of the option typically? It's never less than 5 years, normally somewhere between 5 and 10. It is tied to an individual shareholder. So it could be the case that in one company we have several put call options with several different dates, but it is always one date in advance for each individual, and normally between 5 and 10. For example, if it's 10 years and I have sold 70% of my business to you, I have a 10-year option that I can put the business to you. Let's say after 5 years, I don't want to work anymore and I want to put the business to you. How do you guys think about financing the option? Let's say, for example, all the companies put it to you at the same time. How do you think about that? First, they can't put it to us at any point in time up until 10 years. They can only put it at the date which is stated in the agreement, which means that we now relatively well when we will have cash outflows to exercise those options. I don't have year-end report in front of me, unfortunately, but if I'm not mistaken, we have approximately 210 million maybe. It's 210 million? Yes, 210 million in the put call now. I think approximately 56 million of those are within the next 3 years. The second thing on your question is we treat the put call debt as financial debt in our reporting. In our leverage or debt ratios, for instance, and our bank accept it like that. That means when we have the cash outflow to settle or exercise the option, we can basically just replace it with bank debt because it has no impact on any ratio or debt-like instrument in our reporting. That's really the idea. Really, you have to manage that liquidity in understanding how many of those puts are coming up potentially per year and how much cash flow you need to finance that, as well as finance growth in acquisition outside of that, right? Yes, but as I said, firstly, we have obviously a very good cash flow or liquidity forecast when it comes to those put calls having to be paid and settled. Secondly, our banks and credit providers treat the put call as a financial debt, meaning at the time when we need to pay them, we can replace them with a bank debt basically. How do you think about return on equity and using leverage to boost that? Well, for return on equity, we should certainly be higher. And if you read our report, you will see that it is technically lower now in the end of the last year. Return on equity is a little bit of challenging metric in our business because the earnings component is not annualized. Second issue is that is exposed to a lot of re-evaluations due to IFRS accounting, which has very little to do with underlying performance of the business. For instance, this year in Q4, we had a hit the profits of the 3.6 million due to the change in the future tax rate in the UK, which impacts our deferred tax liability. It has absolutely no cash flow impact as of now, but it impacted the return on equity quite a lot. Why are you buying bigger companies? It's a bit different by accident, I would say. Obviously, there is a benefit of buying a bigger company, and normally there is a bit more structural capital in a larger company. It is easier if you are in a situation where you need to replace management, for instance, and there may be a bit more overall structure around it. But what happened, I think, during last year was when you have increased volatility predominantly in the credit markets, private equity buyers may struggle a little bit more because their returns may be a little bit more exposed or prone to attractive credit terms than what ours are, because we are more conservative with the use of leverage. We saw an increased inflow of larger opportunities, which in our space is then companies that make, call it around 10 million of EBIT. And we certainly get those opportunities every once in a while, and did so even the years before. Normally, we either got an indication even before sending indicative offers that it would be probably a bit too competitive for us, or we understood that after having sent an indicative offer, whereas last year we got through on more of those opportunities than before. How many deals do you think you could do a year maximum today? I think we are certainly capable of continuing to do the same level as we have done up until today, and even a bit more. Just for reference, up until today, I think the most we did was in 2021 when we bought 9 companies. 2 of them were add-ons, but call it 7 platforms. And last year we bought 6 companies. I think that's a level that we can continue to work with without any issues or running into problems with just managing the processes. There always seem to be so many more companies that come in the pipeline. Every serial acquirer I speak to, I've done work on various different businesses in software and Nordics, UK, US. They just say the pipeline gets bigger every single year. Is there any end to this? As long as it's that way, I don't think, and I don't see any issues. It is just great, because then we can be even more strict and stringent. We can make more and more comparisons between various investments at any given time. As long as the pipeline grows, I don't have an issue. What keeps me awake at night is when I think the pipeline is too weak. Then we have an issue. What did you learn from working with Fredrik over the last few years? Well, I have obviously learned a lot from working with Fredrik, also working with Thomas. I think the importance of consistency is really something that is key learning, I would say. I came from a background where maybe you were a little bit more flexible in what you did and exposure to different things. Obviously, you can look at what we do from the outset and you see you are sector agnostic. You own a beauty retailer, as you mentioned, and you own a single-use medical device business and everything in between. You can say that it's not very focused, but I think we are very consistent and focused in what we look for, and we look for good companies. Sometimes a good company is the beauty retailer, and sometimes a good company is a single-use medical device. And we want to make sure that we find those, no matter which industry or country they are in. Is there anything around deal making or getting transactions done that you have learned with Fredrik and Thomas relative to private equity? Well, I think the consistency goes across actually, because it is also very important staying true to what you have said, staying true to your word, maybe not renegotiating everything that is not a massive importance just to make a buck, but I would fit most things into this. Call it value of consistency maybe. For us, it is very important that people feel they can trust us. And if we say something, that we can actually stand by and out there do it. So we made it. It was a bit different podcast this time. It was more like a research interview version of me reading the interviews. First one was with Fredrik Karlsson, CEO of Röko. The second one was with the current CFO, Johan Bladh. So I hope you enjoyed this and see you in the next one.